Micron is one of the hottest stocks on the market right now, but also one of the most volatile. Hey, I'm Brian Feroldi. I've been investing in the stock market for 20 years, and in this video, I'm going to do some fundamental analysis on Micron to see if this is a business worth investing in. Now, Micron is a company that focuses on making memory chips that go inside computing devices. It has two main product lines. The first are DRAM, which are used in servers, phones, and PCs. And then it has its NAND flash storage, which is used in solid-state devices and mobile devices. Now, Micron is really one of just 3 companies in the whole world that can manufacture at scale, and its main competitors are Samsung and SK Hynix. Now, what makes this business so attractive right now is that it's been pushing into high bandwidth memory. Now, this type of memory is a specialized memory that is used directly in AI training. And this is a newer business line for Micron, and demand for this has just gone vertical. If you look at this company's main business segments, the largest has become its cloud memory business, or CMBU. Then there's its mobile and client business, or MCBU. Then there's the company's core data center business. And then finally is automotive at 13% of sales. Now, its cloud memory business is currently in hypergrowth mode, and it's grown at a 200% compound annual growth rate over the last 3 years. Its data center business is no slouch at 71% compound annual growth. Its mobile and client business is growing about 38% per year. And finally, its automotive business is also growing 31% per year. So demand across all 4 of its major business segments is absolutely explosive right now. Now, that is a stark change from history, because if you look over the last 10 years, Micron's business has historically been very volatile and cyclical. This is why, for the majority of this company's history as a public company, it hasn't been all that great of an investment. Demand for this company's products has been highly cyclical, which has not led to great returns for investors until recently. And you can see this much more starkly when you look at the company's operating profit here in the blue line. You see that in good years, profits have soared, but in bad years, profits actually can turn negative. Although over the last 3 years, the trend has clearly been up and to the right. So when rating Micron on a 1 to 5 scale, I would currently give its business model a 4 out of 5. Now, the next thing to figure out is which phase of the business growth cycle is Micron in. So revenue is clearly growing, it's making money and profits are growing fast, and the company is actively paying a dividend. Those are clear signs of a company that is in phase 4 of the business growth cycle. I'm going to choose phase 4. Now, the next thing to analyze is the company's moat, both its size and direction. Now, I think the company currently has a narrow moat. A big reason why is because this market is currently an oligopoly. Basically, there are 3 big players that have controlled 95% of the market for more than 20 years. And because of the cyclicality of the market, this hasn't been a high demand places for new competitors to come into. Now, the downside to the market historically is that it's been plagued by commodity pricing. Margins swing up and down based on near-term demand. So on the plus side, there are high barriers to entry for getting in. On the downside, there are 2 major competitors. That's why I give this company a narrow moat rating. Now, for moat direction, I think it's very clear that this company's moat is widening right now as growth has just taken off. Its new chips have clearly created a differentiator for this business, and you can see that in the explosive growth for its cloud memory business. And what's so exciting about this new business is that these new memory chips go through a qualification process that actually takes several months. So that means that if somebody chooses the company's chips, it really has to stick with it. Otherwise, there would be major disruption to the company's business to switch away. So that is happening to widen the company's moat over time. So I'm happy to give this company a current moat rating of 3, but a direction of 5, growing quickly. Now, the next thing to think through is the company's growth potential. Does it have good long-term growth prospects? Well, we know that over the past couple of years, growth has absolutely been explosive. And if you look at revenue estimates, that trend is only expected to continue. For 2026, revenue is expected to hit over $110 billion, and that's expected to grow to $173 billion the next year. So at least for the time being, demand for this company's memory remains red hot. What's even more exciting is that revenue growth, which is expected to essentially be triple digit over the next 2 years, is expected to directly translate into strong growth in earnings per share. Over the long term, analysts are currently estimating over 100% annualized growth in earnings per share, which, if that comes to fruition, would not only be a huge acceleration for what we've seen in the recent past, but would also be unbelievable growth for a company of this size and scale. So when thinking through the company's both near and long-term growth potential, I think you have to choose at least above average, if not extremely high, for the next couple of years. Now let's take a look at the company's management team. Its CEO has been in the corner office for more than 9 years. He currently owns more than $400 million worth of stock, so that gives him plenty of skin in the game. Now, Sanjay was the former CEO and founder of SanDisk and took the company all the way through a $19 billion acquisition. So this is a CEO with a serious track record behind him. Moreover, since he's been in charge, we have seen absolute explosive growth thanks to his decision to pivot the business to focus on AI. That is a decision that is clearly paying off today. Moreover, he recently committed the business to about $200 billion in domestic manufacturing. Now that is a huge bet on continued growth in this sector, which once built out will give the company plenty of manufacturing capacity if that demand stays high. Looking at some other details, the company gets mixed ratings on Glassdoor, but they have a fabulous track record of exceeding expectations. They're also somewhat shareholder friendly, and their key numbers actually look pretty good. So overall, I would give Micron's CEO a 5 out of 5 rating. Next, we need to take a look at the company's risk analysis, at least on a fundamental basis. So the big risks here is that this has historically been a cyclical business. And while the company is positioning itself to damp down on that cyclicality moving forward, there are no assurances that that cyclicality won't return. In addition, there are geopolitical things to think about. So back in 2023, China actually banned Micron from doing business in the country, and that was a major source of revenue at the time. So this company remains in the crosshair of US-Chinese relations. And there's also the fact that this business is very capital intensive. Building out these factories is hugely expensive, hence the $200 billion build out we were talking about before. So that is a huge investment that, if it's not met with the appropriate demand, could spell disaster for shareholders. Another risk to keep in mind is that revenue is highly concentrated. So the company has big concentration in the US market and close associated with the hyperscalers, so there is some revenue concentration risk that you need to be aware of. Disruption is also something else to keep in mind. While I don't see any disruptive threats on the near-term horizon, the technology market is notorious for disruptions coming along and blowing out old business models. So that's something that investors always have to keep in mind. Finally, the company is dependent on governments, at least in the near term. There was the CHIPS Act that was used to fund the company's new manufacturing facility and the geopolitical relations that we talked about previously. Now, offsetting that is the fact that this company's financials are currently extremely healthy. Got high levels of cash, very low levels of debt, and it is pumping out profits and free cash flow. So that dramatically helps to lower the company's risk profile. But overall, on a scale of 1 to 5, I would give this company a risk rating of 2 for high. Now, Micron is in the capital return phase, so the best multiple to look at to judge its valuation is the PE ratio. Now, this number is currently about 40. And that number is significantly higher than its 5-year average, about 20. So that means that when looking at the trailing PE ratio, this number is actually quite high. Now, one problem with using the PE ratio on a company that is historically volatile and one that's growing very quickly is that trailing PE ratio doesn't always factor in the cyclicality of the business or the company's extreme growth profile right now. That's why I like to run reverse discounted cash flow analysis on companies like this, so we can see what kind of growth rates are built into the company today. So using a stock price of about $860 per share and $10 billion in free cash flow, 2% terminal growth rate and a 10% discount rate, Micron has to grow its free cash flow by about 30% annually over the next 10 years to justify today's valuation. It means this company has to grow its free cash flow to about $139 billion by 2036 in order for today's stock price to deliver a 10% return over the next 10 years. Now, the company is currently investing hugely in its operations right now, and the demand for this company's products is currently insatiable. So that might entirely be in the realm of possibility, but it does give you a sense of the extreme growth that needs to happen for this stock price to pay off in the long term. So when thinking through this company's valuation today, I would give it a current rating of 2 out of 5. I don't think it's crazy expensive given this company's growth potential, but I don't think it's very cheap either. So taking everything into account, is Micron a buy, sell, or a hold? Now, before I answer that question, I want to point out that some people are saying that Micron stock and many stocks like it are currently in a bubble. But when it comes to figuring out bubbles, it's important to know that there are 2 distinct types of bubbles. Now, the first type of bubble is called a valuation bubble. This is when the price of something like a stock rises far faster than the fundamentals of the underlying business would justify. Think of Pets.com in the year 2000 as an example. The stock kept roaring even though the fundamentals didn't keep up. I don't think we can say that Micron is in that kind of bubble because the fundamental growth here has been outstanding over the last couple of years. The growth has been huge and profits have kept up. So I don't think the valuation today is all that extreme, even though it is very high. However, the second type of bubble is the one that I'm actually worried about. And this type of bubble is called an earnings bubble. Now, this occurs when a company's earnings are temporarily inflated due to a short-term trend. Now, when this happens, a company's stock price soars, but so do its fundamentals. Now, that's fine so long as the fundamental trend is sustainable. But if the fundamental trend is not sustainable, that's when you could be in an earnings bubble. And even though everything looks relatively okay on paper, if the company is currently over-earning its current long-term potential, that could actually spell trouble for investors in the long term. Now, to figure out if Micron is in an earnings bubble, there's a couple things that investors should watch in the long term. First and most importantly would be to keep your eye on this company's margins, namely gross margin and operating margin. If the business has successfully transitioned and is no longer highly dependent on cyclical demand, then the company's margin profile should be sustainable. But if you start to see margins start to tail off, that could indicate that the company was actually in an earnings bubble. The second thing to watch from here is customer concentration. Currently, the hyperscalers in the US are making up a large portion of this company's revenue growth. You want to make sure that that concentration doesn't lead to trouble if one of those customers were to leave. And then the final thing that I think is worth watching is the marketplace, specifically the competition that it faces from its two biggest competitors. You want to make sure that Micron is growing at the same or faster rate than they are to show that this company's products remain in demand and that it's not ultimately losing market share. So when taking everything in together, this is a business that I like. It's in the capital return phase. The moat is currently narrow but rapidly widening. The growth potential is very high, at least in the near term. The management team here looks very good, but offsetting that is the fact that this is a relatively higher risk business, or at least it has been historically, and the valuation is on the more expensive side. That's why, when taking everything into account, for me, this company is a hold right now. That's not because this isn't a good business that has lots of great potential, but because I can't yet tell if the company's earnings are in a bubble. And I've personally been burned in the past from investing in companies like Gilead Sciences, Fulgent Genetics, and Zoom, all of whom had explosive growth, but it turns out that they were riding an unsustainable earnings wave. Now, Micron might be completely different, but I'm personally not convinced yet, and that's why I'm happy to keep this company on my watch list.